Hello all, welcome to www.bspsolutions.com. Okay, this is a series of financial planning with the help of Excel. So, to explain ahead, uh, let me first uh, explain you why is there requirement of using Excel for doing financial planning. Now, let's say uh, Kevin has recently launched a small online retail store. Now he has a basic understanding of finances, but he struggles with structuring financial statements. He finds financial jargon confusing, difficulty in tracking the income, expenses, and profits effectively. So he would need a simple yet effective way to understand his business financial health. Hence, to overcome all these challenges, we resort to Excel financial planning so that he can build financial statements from scratch using Excel to track business performance and make informed decisions. So, financial planning with the help of Excel involves leveraging Excel's powerful tools and formulas to create, analyze, and manage financial plans. It helps individuals and businesses track income, expenses, investments, and future financial goals efficiently. So, Excel's flexibility allows for customized financial models, budgeting, forecasting, and scenario analysis. The objective of this webinar is to make you understand financial planning basics, covering the key financial concepts such as budgeting, cash flow management, savings, and investments. We'll be covering Excel tools for financial planning so that you understand how to use formulas, pie tables, data validation, and charts for financial tracking. We'll be covering scenario analysis and decision making, that is using what if analysis and sensitivity analysis to make informed financial decisions. And finally, it will help you to automate financial reports by learning techniques to streamline financial reporting using Excel macros and dashboards. After the session, the key takeaways will be: first, you'll be master Excel functions like sum if, VLOOKUP, if formulas, and other financial functions. You learn how to create dynamic financial dashboards. You will gain hands-on experience in financial data visualization and forecasting. And of course, you will understand risk management through financial modeling. Now, first we will start with understanding and creating financial statements using Excel. So, in financial planning, there are three key financial statements which would help in analyzing companies' performance as well as financial health. The first and foremost is your income statements. You can also call it as P&L statements, profit and loss statement. Now, this shows the company's profitability over a period. You can say monthly, quarterly, or yearly. The key components would be revenue, that is sales. It is the total earnings from selling your goods or services. Later on, I will be showing you extract of all the three statements. Then income statement has revenue, it has cost of goods sold, then we have operating expenses, EBITDA, net profit. So the importance here in the why do we prepare income statements? Basically, it helps stakeholders assess if the business is profitable or it is operating at a loss and where cost can be optimized. Second is our balance sheet. This provides a snapshot of a company's financial position at a specific point in time. The key components will be assets, liabilities, and equity. Now, it is important because it shows whether the company has enough assets to cover its debts and if it is financially stable or not. And lastly, we have cash flow statement. Now, this will track the actual cash movements, showing how cash is generated and spent. The key components will cover operating activities, that is cash from day-to-day business operations, like you can say customer payments, salaries, rent. Next, it will have investing activities, that is cash which is spent or earned from investment, buying or selling equipment, property, and stocks. And thirdly, it will cover all the financing activities, that is cash from investors or lenders, that is loans or of issuing the stocks or dividends. Now, it is important because a company can be profitable on paper, that is on the income statement, but still it may run out of cash, that is cash flow statement. So this statement we prepare to ensure whether the liquidity is managed properly or not. If you see, all of these statements are connected. The net profit from the income statement flows into retained earnings in the balance sheet. Also, when we talk about cash flow statement, this adjusts the net profit to reflect actual cash which is received or spent. And finally, the balance sheet shows the company's total financial position, including changes in cash and assets. So all of these three statements are interconnected, and we're going to see how can we create these statements from scratch. So we are building financial statements from basic. Okay, the first one, as I told you, is my income statement. Okay, let's start building our dynamic three statement model, where we will be linking the balance sheet, P&L, and the cash flow statement for Technowave firm. This is a mid-size IT company. Okay, you can see here we have the we're going to plan the estimated figures for P&L for the year 2025 and 2026. On the other hand, I will come to the balance sheet afterwards, but I have the figures for 2024. This is the actual figures, and accordingly we're going to plan for 2025 and for next 2 years. Here we are doing planning for 2 years consecutively. Now here you can see these are all the headings which are there in your P&L account. You have revenue from contract with customers. This is basically your sales, receipt from your sales. Then you have cost of sales. Adding when we deduct the cost of sales from revenue, we're going to get gross profit. Then you have selling and distribution expenses, general and administrative expenses. These are known as operating expenses. When we deduct operating expenses, okay, from administrative expenses, you can say either ways, from gross profit you get EBITDA. Now this is earning before tax, before depreciation, and before amortization. So right now, if in this figure right now, you will only deduct from the gross profit the administrative expenses, then you will get EBITDA. Okay, so this is your earning before you have deducted any sort of tax, interest, depreciation. Now then we have over here depreciation. Once you deduct depreciation, you get EBIT. Now this is earning before tax. This is also known as your operating profit. Finally, you have tax figure. From the operating profit, when I deduct tax, I get net profit or loss for that year. Now over here you can see notes. These are certain notes which are provided in the schedule. So if whenever we create P&L, straight away we do not create all the columns, all the headings which are there. Okay, like the child expenses under selling and distribution, there might be many expenses, okay, which can be termed as selling and distribution expenses. So this is a total of all those expenses. Like you will have salaries, you will have wages, and now this is the income statement for IT firms. So there would be license fees of the software. So all those various expenses, they contribute to make selling, distribution, general and administrative expenses. So rather than keeping all the expenses over here, we make P&L very simple, and we keep all those expenses, the subheads, under the notes. Okay, so here I'm not providing you the bifurcation of the notes. I'll be picking up the total of all the expenses. We already have the balance sheet P&L finalized for the year 2024. Here we are forecasting, we are planning the budgeted figure for the next 2 years. So all these figures will come from assumptions. Okay, below here in red, I will create assumptions which are based on market trends, which are based on average earnings, and which are based on last year, or you can say historical data calculations. So first assumptions is our sales, the revenue from the here contract with the customers. So let's start with the assumptions. I'll write the figures over here. These are all based on your industry trend, market trend, and your historical data analysis. So for the year 2025, okay, I'm doing assumptions for the revenue. This is my billable hours. It would be in the next year, and here I'm assuming the billing rate per hour on an average would be $100. Similarly, let's quickly make the other assumptions. Cost of sales, here here it is the bifurcation of the cost of sales. This totals up to be 40%. Selling distribution expenses, we are assuming it to be 12% in the next year, and general and administrative expenses is 10%. Depreciation, here we are charging 10%. Now this is fixed. Okay, this is fixed in the sense whatever is charged this year, the same will be charged if we are following straight line method. So here for depreciation and taxes, we do not make any assumptions on the basis of market trends or fluctuations in the revenue. We straight away, this has been provided once decided. Whenever the business starts, the method of depreciation would be decided beforehand. The same depreciation rate we're going to take, and taxes are provided. This is the government regulation that one has to follow. So again, the rate of tax is fixed. Now rest all rates will keep same for the next year also. So you can see we have created the assumptions. Okay, we have provided all the percentages for the increase in the cost of goods sold and for your administrative and other expenses. Now let's on the basis of the same assumptions, let's create the forecasted income statement over here for the year 2025. Revenue from the customer. So your billable hours will be multiplied with the billing rate per hour. Cost of sales over here, this is for 40%. So 40% of your revenue will be your cost of sales. Okay, here if you are also provided in your P&L, on your income statement, if you are provided with the bifurcation of the expenses, you can even take the bifurcated rates on the revenue. You can charge it and you can get the exact figures for salaries and wages as well as your licensing cost. So here we are taking 40% straight away on the revenue. And we will see that over here this is expense, cost of goods sold, so we'll make it as negative. Over here we'll put a minus sign. For all the expenses we're going to put the minus sign. Now if you see your selling and distribution expenses, this is also, I've given the rates over here. So this is 12% of the revenue, and your general and administrative expenses is 10% of your revenue. So this has calculated over here. Once you provide the assumptions, so straight away the figures get calculated on the basis of your revenue. If you want to check your revenue, 12% of your revenue is your selling and distribution expenses. And let's check for general and administrative expenses. Again, you can find 10% of the revenue is calculated as your general and administrative expenses. Now we'll find the rate here. Depreciation is provided at 10%. So this is fixed on the straight line method. So whatever is your existing fixed asset, on that you'll provide 10% of the depreciation. So here in the balance sheet, if you see, the property and equipment is almost 5 lakh. So 10% here, 10% of 5 lakh would be your depreciation. You can pick this up from balance sheet itself, or you can straight away write you can hard code the figure also. Or I will, in spite of just writing the rate over here, I will just pick the rate from the assumptions that we have created, so that if any time we change the rate in the assumptions, our figure will respond over here simultaneously. It will get changed equally, and this I'll make it as minus because again this is one of the expenses, 50,000. If you check the text, now this revenue over here, and 15% of the revenue, as per the assumption the tax will be 15% for the next year, so it has taken automatically, it takes 15% of your revenue. Quickly we will see the formulas. Gross profit, if you see, this is the sales minus cost of sales. Okay, you can see over here I've added this over here because already I have over in cost of sales I am putting minus signs. That is why in the total I'm not putting I'm not taking it as negative. I am summing this up because already cost of goods sold I have made it as negative. All the expenses I have made here as negative. So here if I see EBITDA, now I'm just adding all the figures because here I have straight away put the negative sign. That is why it is finding the difference between gross profit and the administrative expenses. If you do not want to show the figures in negative, you just have to change the formula for your gross profit or your EBITDA. Now your operating profit, this is the difference between your EBITDA and depreciation. Since here again I have taken as negative, so this here I am summing both the figures. If I take the actual calculation, which is EBITDA minus depreciation, then since this is already negative, it will add up the figure. And finally, net profit, it is the difference between your operating profit, you can say EBIT, and your tax. Now we'll do the calculation for the second year planning. Revenue would be billable hours multiplied by the billing rate per hour. So here we get the figure 11,20,000. Now we'll find cost of sales. The percentage over here, this is 40%. 40% of your revenue. Now here the formula, this is summing it up. Okay, so either you can change the formula of total if you do not want to show any of the figures in negative. But here what I'm doing, I will just change the sign of cost of sales. So I'll make it as negative so that here in the total it provides the correct effect. Selling and distribution expenses, over here this is 12%. So 12% of your revenue. This is your assumption of 12%. Revenue this year is 11,20,000. So on the basis of the assumption, you're getting your selling and distribution expenses. Similarly, I've calculated the administrative expenses. If I see, this is 10%. So 10% of your revenue this year. Now depreciation is fixed. Again, this is 10%, and your fixed assets, if you're not buying any fixed asset, if you do not plan to buy any fixed asset, the depreciation will remain same. Otherwise you have to you have to prepare another schedule for your for your fixed assets, current assets, and for your depreciation basically, and you have to calculate the accumulated depreciation over the years. you have to see the estimated life of that asset, and then the depreciation will be calculated accordingly. Here we are not adding on any new asset. Whatever is the property and equipment we already have, the depreciation is being calculated on the existing fixed assets. So I have a fixed asset, I have property and equipment. I showed you in the balance sheet. In the actual figures of last year, I have it as 5 lakh. So depreciation will be 10% of your fixed asset, existing fixed asset, and again we'll make it as negative so that the impact on the total is correct. Tax percentage, it is same, we are keeping it constant. We are assuming no change in the taxes, so again this is 15%, and 15% on your total revenue. This gives you 1,68,000. So profit for this year, now you have calculated with the help of assumptions, and by using various formulas you have calculated the exact profit or loss for the year. Now you see this figure is positive, that means we have a profit. We have planned, according to the forecasted figures, we are planning to have the profit of 1,80,000 next year, and in 2026 we are planning for 2,07,600. So this is the first statement we have prepared today. Next we have to prepare the balance sheet and cash flow, so that we will resume tomorrow. We have finished creating the first part, that is our income statement. We have to create the second stage over here, is that we will be creating the other two financial statements, that is balance sheet and our cash flow, so that we're going to resume tomorrow. So thanks for joining today, and if you have any queries you may write to us at www.bspsolutions.com.